Welcome to this explainer. Today, we are throwing on our investment analyst hats to truly x-ray the financial engine of BBVA Mexico. We're cracking open their 2025 annual report and their Q1 2026 results to see exactly how one of the region's absolute most dominant banks is rewiring its operations right from the ground up.
Right off the bat, let's just talk about the sheer macro scale here. You're looking at their headquarters literally towering over the Mexico City skyline, and honestly, it's the perfect physical metaphor for their dominance in the market. But as any seasoned investor knows, buildings don't pay dividends. Customers do.
And those customers give BBVA a massive 24.2% market share. Thinking about this through a Warren Buffett lens, this isn't just market participation, right? This is an incredible economic moat. They are the absolute leader in banking system funding, effectively setting the pace for the entire region.
So here is our roadmap to unpack this financial juggernaut. First, BBVA Mexico at a glance. Second, the digital banking boom. Third, financial engine and profitability. Fourth, managing risk and provisions. And fifth, capital and shareholder returns. Let's dive in.
Section 1. BBVA Mexico at a glance. According to their 2025 to 2029 strategic roadmap, management is aggressively pivoting away from the whole slow-moving, traditional banking model. They're not just treating digitalization and artificial intelligence as handy little tools, they're making them the absolute core enablers of their future growth and sustainability.
Moving into Section 2, the digital banking boom. Okay, you have got to hear about this digital shift from the first quarter of 2026. A staggering 76% of all transactions are now happening via mobile or web. Traditional teller windows, they've been completely marginalized to just a mere 3%. We are talking about a monumental rewiring of how capital flows through their systems every single day.
And listen, this isn't just about folks checking their account balances on an app. We're talking about high-value, complex products. Practically 100% of small and medium enterprise digital credit lines and 94% of investment funds are sold entirely through digital channels. They've successfully digitized their absolute most lucrative commercial interactions.
So what does that look like in human terms? That translates to 27.1 million digital customers. Let that massive number sink in for a second. That's 80% of their total customer base. They are running a digital bank at a scale that legacy competitors can literally only dream of.
Section 3. Financial engine and profitability.
All right, looking at the Q1 comparisons between 2025 and 2026, the top-line growth is just stellar. Net interest income grew from roughly 57 billion pesos to over 62 billion, and trading income jumped up nicely as well. But look really closely at the bottom line for a second. Net income saw a slight dip, dropping from 24.7 to 23.5 billion pesos. Why is that? Keep that in the back of your mind. Because despite that slight dip in raw net income, their return on equity stood at a massive 24.0%. For context, any investment analyst evaluating management quality knows that an ROE above 15% is excellent. 24%? That is elite. It proves the core engine is highly effective at compounding investor capital.
Which brings us to Section 4, managing risk and provisions. Now, in the banking world, revenue is honestly only half the story. The other half is getting your money back. We measure that with the NPL, or non-performing loan ratio. It's simply the percentage of bank loans in default or close to it. It's basically the ultimate pulse check on a bank's lending safety.
For BBVA Mexico, their NPL ratio sits at an impressively low 1.6%. But here's the real kicker. Check out their coverage ratio of 204.5%. For every bad loan they might have, they hold over double that amount in reserves to cover it. Applying Benjamin Graham's investment framework here, that is a phenomenal margin of safety.
And this actually brings us right back to that slight dip in Q1 net income we noticed a minute ago. It turns out it was entirely driven by proactive risk management. They intentionally increased their loan loss provisions to over 21 billion pesos to recalibrate their risk models. Their filings explicitly state their loan portfolio is not deteriorating at all, they are just strategically padding their safety net.
Finally, let's wrap up with Section 5, capital and shareholder returns. So what does all this digital dominance and rock-solid risk management actually yield for you, the shareholder? Aggressive capital returns. That's what.
According to a July 2026 SEC filing, they've already completed nearly 63% of a massive €918 million share buyback tranche. By retiring these shares, they are fundamentally increasing the intrinsic value of every single share left over.
And honestly, it gets even better, because alongside those buybacks, they are steadily growing their cash dividend payouts. In December 2025, they paid out 15 billion pesos. Just a quarter later, in March 2026, they declared an even larger 16.75 billion peso dividend. They are taking all that immense digital efficiency and funneling it straight back into investors' pockets.
Bringing it all together now, with an unmatched digital ecosystem, an elite 24% return on equity, and a massive margin of safety protecting their loan book, the takeaway from this explainer is pretty clear. The question isn't just whether BVA is a good investment today. The real question is, has BVA quietly built the definitive blueprint that every other bank will be forced to copy tomorrow?